Hello folks, this is Raj Sastry from Raj Option Trading. Today I want to talk about one of my favorite topics. It's the healthcare IT stocks. So healthcare IT is one of the fastest growing segments with a CAGR of compounded annual growth of 15.8 percentage during up to 2024. So it's a very emerging market and a lot of players in it. Let's look at a couple players in this area. Also, I got some images here. Market leader Veeva Systems, Veeva.com. They got a tremendous cloud platform, and also 10x Genomics. It's again a good company. They also have a compelling platform for folks to use. So, with that, let's look at a couple companies in this area and see why they make sense. So, this is the top companies in this area, top performing companies, and just the one in the bold are my favorites: OptimizeRx, Schrodinger, YI or 111 Inc, 10x Genomics, One Life, Evolent, Simulations Plus, Phreesia, Veeva Systems, MTBC, and the list goes on. We'll look at these in details. So next we'll go into numbers, little more details behind this. So with that, this is the chart of these stocks, and the way this chart is organized is it's by descending order of performance. The one at the top has got maximum yearly performance, and it's in the descending order. And typically, what I look as I highlight these companies are: one is performance should be as high as possible. Then I look for revenue growth should be double digit. So clearly this is triple digit here. Then I look for good gross margin. It has to be very good. So these are the key topics or key categories: the performance, the revenue growth, and the gross margin. Then I also look at the cash, debt, and some of the other areas. So with that, the ones in the bold clearly have got double-digit revenue growth, as you can see. And in some cases, it may not have double-digit revenue growth. For example, here Omnicell, but it's got a good gross margin. So that's the criteria. And now let's go into few of these companies and into a little more detail and take it from there. So with that, the first company we'll talk about is OptimizeRx or OPRX. It's a smaller company, as you can see, $762.76 million market cap, and stock price is around 45.86. So this is really into provision of digital health messaging via electronic health records or EHR. So it really provides a workflow solutions, basically for patient education, for brand messaging and whatnot. And CEO is William Febo. And if you can see the stock chart here, very nice stock chart, has done very nicely in the beginning, a little bit, not so good, but now they took off since a year or so. They got about $10.52 million cash, and debt is low, as you can see here, $448,000, which is relatively low. And if you look at the market cap, they've been steadily increasing market cap. This is one thing I always look for: a steady increase in market cap that tells us this company is grabbing the market share. And between 1231 and now, they're almost close to doubling the market cap, which is a good story. And the revenue itself, as you can see here, continuously going up. 7.58 to 16.43. And off late, if you see the revenue growth, it's a triple digit revenue growth, which is a very good acceleration. And they've been surprising Wall Street with the revenue surprises. And on the EPS side, they surprised 3 times. And back in March 31, they surprised on the negative side, which happens once in a while. But importantly, they surprised on the positive side on the revenue. And gross margin is very nice, as you can see here, 57, 58, which is a good gross margin. And on the net margin, they're negative, meaning they're still not making money or profit yet. Overall, I feel very good about this stock. Company is doing nicely, and stock is kind of reflecting that. And from a earnings summary, they got some key callouts. One is the revenue increased 123%. It's really year over year for that quarter, and gross profit also increased nicely. And company raised some money through equity offering. These smaller companies normally provide do equity offerings to boost their capital. And they finished the year with the pipeline of more than 180 million dollars. So this is where this is the deal pipeline. So they are making deals so they can grow their pipeline of deals. And net loss itself is 2.2 million, and they're improving it from 3.1 million, which is a good story. And outlook also, they're expecting a strong growth in the future. And they're also one of the fastest growing companies in North America, and they want to be on that list. So it's a they have some conviction to really improve and grow, which is a good thing. So with that, being a smaller company, $762 million cap, and a stock price of 45, and a good story, I feel it's a good stock to take it forward and invest in any pullback. Next, we'll look at Schrodinger. It's SDGR is a symbol, about $5 billion company, bigger than OptimizeRx, as you can see here. 97% approved the CEO here. And these guys are into drug discovery, materials design, and they also have a computational platform. And the stock, as you can see here, it's a little bit of a up and down type story by looking at the chart. But overall, I think it's higher high, as you can see here, so which is okay. So only thing we have to do is we have to buy it on a pullback, just like now, just after the earnings with the negative surprise, the stock pulled back hard. So it could be a good opportunity to buy some and keep it for the long haul. If you're a trader, you could also, as you can see here, they have a nice up down. So now it's kind of coming down. If you buy here, it will go up in a quarter or so. You could trade it out. So with that, from a market cap perspective, these guys are improving the market cap. From 2.73 back in March. Now they're into 5.04 billion, which is a good market cap acceleration. That tells me these shorter term pullbacks are a buying opportunity. And revenue itself, as you can see here, they're growing the revenue from 25 million now to 33 million. I would have liked a little more acceleration in the revenue growth, but it's okay. It's not bad, but I would like to see a little more. And this quarter, they surprised with a negative surprise on the revenue side and also negative surprise on the EPS side. That's the reason stock pulled really hard. They need to prove themselves in coming weeks and months. And overall gross margin is it's pretty good, 59, 60, not bad. And they also have positive net margin, which is a good story, because most of these companies typically have negative net margin, and these folks did have negative net margin in the past, but they turned positive back in September. So with that, from an earnings summary perspective, their earnings revenue itself up 2% year over year, which is a little bit less, but still it's a positive revenue growth. And software revenue, this is very important. Software revenue is up 39% year over year, which is a good story. And they also plan to submit additional new drug applications, which tells me they're really working on new things, which is good. And they also have collaboration with the Bristol Myers, which is a good, it's a good company. And they're also expanding their collaboration with Google Cloud to increase their capacity and speed, which tells me they're investing in their growth, which is good. And from an outlook perspective, they are expecting around 124 to 142 million, for next year, which is kind of in line with what they're doing now, maybe a little bit appreciation, which tells me, their outlook is kind of, a little bit flat to up. So with that, I would, buy on a pullback. It's kind of in my mind, it's a, not a compelling story, but on a weakness you can buy, and then you can sell it as it goes up a little bit. So next we'll look at two more companies. So next one is really a China-based company, 111 Inc or YI. So it's a smaller company, $1.33 billion company. These guys are into provisioning pharmaceutical products and medical services through their retail pharmacy. And it's a co-founder led. The founder is still there, and stock price is very low, as you can see, $16. And chart itself is, they're doing well last year or so, but it's, a little bit, not so nice looking chart here. If you look at the market cap acceleration, I think they're, kind of, in the staying in the same place, or maybe a little bit lower. That also reflects in the stock chart itself. But one thing caught my eye is really their revenue growth. So as you can see here, they got a nice triple digit revenue acceleration, which is a good thing. That tells me they're really working on their the revenue aspect of the revenue side. And from a EPS side, it's a negative EPS, which is expected in these smaller companies. And I don't like their gross margin much. It's about 3.81, and they got a negative net margin. So with this, I think this is a smaller stock, dollar stock price, lower market cap. I think it's okay to buy some on a pullback and keep it a little bit longer term. And from an earnings summary, as you can see here, these guys have announced several strategic partnerships with Bristol Myers and Bayer and a couple of companies. And they're also showing the 8th consecutive quarter of revenue growth that you can see right here, a couple of quarters of positive year-over-year revenue growth. It's the 8th consecutive quarter, which is good. And their net loss is down. Solid progress in digital capabilities. This is one of the reasons their margins are a little bit down. And they also gave good revenue growth for Q4. So that tells me, even though stock has not done well in the past, with these partnerships and solid digital capabilities, they can do well in the future. So with that, I would buy some. I would not be too aggressive in buying, but I would buy some and keep it. Next is 10x Genomics, 10xG. This is one of my favorite stocks in this area. These guys are $16.03 billion company, and they're into life science technology. And they help with they sell the instruments, consumable software itself. So it's a good story. And also 100% of the employees approve the co-founder and CEO, which is a very good thing. And stock price is around $147. And as you can see here, chart is very nice. I've been, watching this stock for a long time, buying call options and buying actual stock also. Nice company, nice acceleration. And right now, with the genomic stocks a little bit, in the downturn, this stock also a little bit, turned down. But I would buy on the pullback. It's a good story. And from a market cap perspective, as you can see here, it's a really nice market cap acceleration. I like it very much. And the revenue also good revenue acceleration, 17%, 49%, which is a good thing. And they've been surprising Wall Street with their revenue surprises. As you can see here, all along revenue surprise. And on the EPS side, many of these smaller companies, they do have negative EPS surprise. As you can see here, this company has got negative EPS surprise 3 out of 4. And very nice gross margin. Out of all the companies that we have seen so far, this is the maximum gross margin. And they have been consistently keeping the gross margin for last 4 or 5 quarters. And net margin is negative. This is because they have, these guys are really aggressive in investing in themselves, and they're not worried about the perception. So I think that's one of the reason the net margin is low, because their R&D, their expenditure is growing because they want to invest in their platform. From an earnings summary, the revenue was up. It's a 298 million, 22% year over year growth. Operating expense, this is something that I was talking about. Their operating expense up 653% due to R&D and D and acquisition. So these are the rapidly growing company. They want to acquire, they want to do R&D. So it's understandable. And Wall Street also makes provision for these type of companies to grow rapidly. And they also have an operations center in Singapore for the consumables. And their guidance was really 61 to 67% growth, which is more than what they have right now, which is a good story. So it tells me their outlook is good. They expect to do well, in 2021. So with that, this is a good stock. I would buy this, either call, or you could even buy Delta 70 call option or stock itself. It's a good story. Next, let's look at One Life Healthcare, ONEM. This is a $5.505 billion company, $41 stock price. And these guys are into, membership services, healthcare membership services. They offer also immunizations, lab service, and whatnot. And it's they have got good amount of cash and some debt, which is not too bad, 12.26 million. 4 is a typo there. And with that, if you look at the stock chart itself, it's a nice looking stock chart. They got some bumps along the way, but overall, it's a higher high, as you can see here. And now, off late, stock has pulled back a little bit. And from a market cap perspective, it's a little bit up and down, but overall, nice acceleration, or kind of steady eddy, I would think. They have got some flatlining here and there, but overall they're doing well. And revenue is pretty nice acceleration, as you can see here. And they've been surprising Wall Street with the revenue surprises. And on the EPS side also, it's a positive EPS last 3 times, which is good. And gross margin is 42.31, which is a little bit less for these type of companies, but understandably it's a smaller company. They're not still making money. That's why net margin is negative. So with that, if you look at the summary here, their membership itself for their platform, it's a 30% increase, which is good, and 57% increase year over year, which is a good thing from a net revenue perspective. And care margin was up 42%. I mean, it's a 42% off revenue. And outlook perspective, they want the membership to continue to grow, which is a good thing. And they also think their net revenue itself will be 465 to 485, which is kind of in line with what they're doing now, which is okay. So with that, I feel overall this company is something to watch for. Maybe on a pullback you can buy some, but I am not as bullish as 10x Genomics on this one. Next, let's look at Evolent Health. These guys are into healthcare delivery and payment services. Little smaller company, $1.660 billion company, and 94% approved co-founder and CEO Seth. And it's a $18 company, as you can see here. And stock chart is not pretty. It's okay, but not too pretty. And they also have good amount of debt on their balance sheet. And with that, their market cap itself, it's been doing pretty nicely, as you can see here. Steady increase, which is what we want to see in these companies. And the revenue itself, I think there's a somewhat of acceleration, not too aggressive acceleration, but a good amount of acceleration, and good year over year revenue growth. And they've surprised on the revenue side last three out of four times, which is good. And even EPS side, same story. They surprised three times, once with the negative surprise. Gross margin is much better than some other companies, but still low. I want this to be more, little more. And they're still not making money. It's a net margin negative. From a earnings summary perspective, these guys revenues up 15%, and they still have some loss, as you can see here. That's why net margin is negative. And they got this platform where people use their platform, and they're showing some numbers here, which is good. And they're also partnering with the multiple physician groups, expanding partnership with Blue Cross Blue Shield and Centene, which is good. They're trying to partner up. And their outlook, they also have a good outlook. They're thinking a strong momentum, and revenue also is expected to be around 830 million, which is kind of sort of in line with what they're doing now, but I think it's kind of neutral to slightly bullish outlook. So with that, by looking at this chart and the numbers, I think this is something that we can buy. um, you know um, Stock is trying to make a comeback at this point. You could buy a little bit, not too much, and take it from there. Next, let's look at Simulation Plus. Simulations Plus, it's about $1.24 billion company. They're into modeling and software, simulation software. I think, as you look at the drugs discovery and development research, simulation can help all these companies to really cut down on the cost and prove out their drugs. And they got the stock price is around $62.28 dollars, and the stock chart is pretty nice, as you can see here. It's a nice stock chart going up nicely, and they got a good amount of stock and some debt, which is really manageable. And from a market cap perspective, it's increasing steadily, as you can see here. Now it's 1.24, and good revenue acceleration 22, 23, good revenue acceleration, positive revenue surprise, and positive EPS surprise last three times. And gross margin is nice, it's around 70, 71, 78. It's a good gross margin, and these guys are also making money. There's a positive net margin. So, with that, I think it's a good story here. These guys know what they're doing, and they're proving it with their revenue numbers and their revenue growth, and also good gross margin. And their summary perspective, the revenue increased 14%, which is a good thing. Gross profit increased 22%. Margin was 77%. Really, they're putting a nice picture here, which is good. There is a positive number here. And outlook perspective, their acquisition of this Lixsoft, it has expanded their addressable market, and they also signed some consulting services project, which is a good thing. So overall, these guys are showing some positive outlook, even though they did not provide the number. But overall, it's a positive outlook for 2021. I'm a believer in this stock. It's a good stock. I would buy some and keep it. Next is Freesaw Inc. PHR, about $2.47 billion company. This is again a healthcare software company. They do things like patient check-in, medical for medical practices, and they also have a SaaS-based platform, which is again a good story. And 76% approve the co-founder and CEO, Chime Indig. I like when there is a co-founder still involved in the company. Same like Simulations Plus, we still have the co-founder. And stock price is around $55, and nice looking chart. These guys are doing really nicely. Now with all these companies, they've also pulled back a little bit. But by looking at the chart and their numbers, I think it's a good story here. And from a market cap, as you can see here, these guys are, a little bit up and down in the beginning, but now they are doing well. 1.14 billion back in July, to 1.62. Now they're into 2.47 billion, which is a good acceleration and good revenue growth. As you can see here, 32, 33, 35, increasing positive year over year revenue growth and surprising Wall Street with the revenue surprise, which is a good thing. On the EPS side, they did a negative surprise back in October. It's just 1 penny, which is okay. And gross margin is pretty nice. I mean, 63, 65, which is very good. And these guys are not still making money. That's why net margin is negative, which is understandable because they got this SaaS platform. They have to invest in that in their own company. So from an earnings highlight, revenue is up 17%, which is good. They're also increasing their number of clients from 1,737 in this quarter, which is more than last quarter. And average revenue per provider client is increasing. And overall, they're painting a positive picture here, which is good. And from an outlook perspective, it's they're providing FY21 146 to 147 million, which is good, and also 25% revenue growth in FY22, which is great. So with that, I would be a buyer in this stock. It's really not a high price stock, a good looking chart, good numbers, positive outlook, overall good story here. Next, let's look at last company, which is one of the fabulous companies, very nice company, Veeva System. It's a leader in the cloud-based software platform for global life sciences. And this company has a lot of customers. It's one of the largest company, and they serve a lot of these pharmaceutical companies. 87% approve the founder and CEO Peter Gassner, and stock price is a little pricey, which is understandable. It's a good company. They got a lot of cash on their balance sheet and some debt, which is very low. And nice looking chart, as you can see here. They got some pullbacks once in a while, but they're all buying opportunity, just like the one we're having now. I'm sure this is also a buying opportunity. And from a market cap perspective, nice acceleration, very nice. I like it. Right now they've pulled back a little bit, as you can see here, with this little pullback in the market, but overall nice market cap acceleration. And revenue itself, good revenue acceleration, as you can see here, 337, and it's a nice acceleration here. And also their year-over-year revenue growth is also very nice. And the EPS itself, I think there's a positive EPS surprise, which is good. Nice gross margin and nice net margin. So overall, I feel it's a good story here. And from a earnings summary perspective, I think they're also painting a good picture here. Their revenue itself increase of 27% year over year, and the operating income itself, there's a good increase, 64%. Net income also increase. I think it's a good story from a earnings summary perspective, and they're also painting a good picture for Q1. So with this, I think overall, this is a good company. I would be a buyer in this stock with this good leader, Peter, and nice looking chart and great numbers. Next, let's look at some of the performances, monthly performance of these companies, and see why they make sense. So, from a performance perspective, the ones in the green background are my favorites. OPRX, $45 stock. They're 28% down from their 52-week high. If you look at the monthly performance, it's a nice, monthly performance. In the past, back in December or November range, they got negative performance a little bit, but they've bounced back nicely. Now they've been doing very nicely, and now they have, like all the companies here, March is a tough month for them so far. They've given back some, they've pulled back some, but overall, I would be a buyer in the pullback. And If you look at other stocks like SDGR, again hard pullback could be a buying opportunity on a dip. So overall, I think these are the ones in the highlighted ones with the green background are my favorites. Now let's look at a few more companies in the list. We got Icad, CHNG, same story. Some of these companies have pulled back hard in March, but overall I think good. They always bounced back. Next, let's look at a performance from a weekly, monthly, quarterly perspective, and also the short ratio. So with that, the ones in the bold are my favorites, mainly because their revenue growth, their 1 year performance itself, which is very nice, and also their gross margin, which is positive double-digit gross margin. So with that, these are the my favorite stocks, in the bold. I would be buyer. My absolute favorites in this list are, you know, one is 10x Genomics, like we talked about. Other one is Veeva Systems. I also like Teladoc, which is a good company. And there are some of the newer players are not on the list because they've not performed that well. I think there is a company many of you know, Good RX. Other one is Amwell, which is a new IPO. I mean, these stocks are good, but they've not performed that well. That's why they did not make the list. So with that, I would be a buyer in many of these stocks, and hope you will have a nice luck with these stocks. Happy investing. Thank you very much.